Welcome back to the Finance Fire Talk for the monthly review. Joining us are MB Capital Strategies and AlgTopo.
Let's heat things up together, AlgTopo for 4.
If we had to sum up March in one sentence, the Iran war has turned the entire market structure upside down. And not just for a few days, but fundamentally and completely as well. I would say, let's start now with the clear hard facts. And I would begin with oil. Brent crude went from 81 to over $106, at times even reaching $126. That's a plus of 30%. And all of that in 3 weeks. That is, of course, very extreme and can also bring very serious consequences. October, how do you see the whole situation here? How might this possibly develop?
In any case, these are not positive news or headlines, especially not in this particular headline. And when the oil price rises, it affects a lot of things, the transportation of food, the production of goods. Basically, energy is needed everywhere, and most of that energy is produced from oil and gas. And when the price rises so extremely, then you can expect that certain things will become more expensive. And when products and food become more expensive, of course, people will want higher wages again. That means you end up heading toward inflation and a wage price spiral. So we'll have to see how this develops over the next few months and 1 or 2 years.
Exactly. Yes, you definitely summarized that very well already. And if the price continues to stay above that upper range of $80, it could also be a recession signal. It could be, let's just see how the situation develops in general. Otherwise, we also have the S&P 500, which overall dropped by 4.6% in March and on the 27th, once again by about 1.5%, and that was the worst day in 2 months. For now, I just want to assess the whole situation like this. Personally, I think you can really notice that people are slowly but cautiously moving out of stocks that have already performed strongly. I'd include tech in that, and you can see that safe stocks are simply becoming more in demand, perhaps. Finally, what I'd like to add briefly is this. Regarding oil, we've also just seen that oil has risen so sharply. What always goes up when oil rises as well? Actually, it's coal. Even though it's very unpopular in such market phases, coal also rises along with it. Why? Because all the production shifts to alternatives that are simply a bit cheaper. And as a result, coal is in greater demand again. And now to get back to the S&P, it's simply the case that you can also notice maybe even tobacco stocks, for example, are slowly becoming a bit more in demand. When it comes to consumer goods, I would say things are still a bit subdued. Quite a few of them are still trading at relatively low levels. Currently, many are still at their 52-week lows. But I would have hoped for a bit more price performance there. Atopa, what's your general assessment?
Well, so in the news, you're already seeing a lot about crash scenarios again. Once again, gloomy forecasts. First of all, maybe we can take a look in advance. How has the S&P 500 actually performed as an example index this year? At the beginning of the year, it rose quite strongly, and now we're basically back to break even. So from that perspective, I think talking about a crash here is a bit premature. We've simply lost the gains we made at the beginning of the year. Those profits have basically disappeared again now. For now, this is still within the normal range, isn't it? It's just normal volatility in the stock market. So whether it will really turn into a crash will become clear in the next weeks and months.
Exactly, that's right. So at the moment, it's ultimately just a correction. Because of bad news, I'd say, which of course also accelerates things a bit, so to speak, like adding fuel to the fire in the end, a little bit of leverage, so to speak. But yes, as you already said, a lot of people are now talking about a crash. And yes, ultimately, you also have to remember that the S&P or even the Nasdaq performed so well last year. If it drops by 5% now, everyone is already in a panic again. You have to keep that in mind, of course. Of course, there are also certain levels you have to watch now where the S&P really shouldn't fall below, so to speak, or where things could get a bit more critical. But as long as that hasn't happened yet, everything is still fine for now. It's all right. And I wouldn't let myself get too worked up about it either. I mean, of course, it can always happen that something crashes or there's a correction, but that's just completely normal. It's simply a market cycle here. Even if that happens, just accept the lower price and maybe take the opportunity to buy more without overthinking it. Of course, this applies now to the S&P and Nasdaq, or for example, maybe even the DAX as well.
This isn't investment advice, of course, but in the end, why not? You just look at the history and then anyone can see for themselves that in such situations, it's actually ideal to simply buy more and above all, not to exit.
Exactly. Yes, that's right. For example, if you just take a 10-year horizon as an example, and then you actually see that there have always been corrections, but they were always recovered and new all-time highs were reached.
Yes, and as I said, if we look at the stock price or the index level, if we consider the S&P 500, we're actually back at the same level as at the beginning of the year. That's a period of just 3 months, so really nothing serious has happened so far. Considering that there are quite a few issues going on in Iran, I think the stock market is actually still pretty relaxed.
That's true. It's holding up well. Let's move on to the topic that surprises me the most, and that's simply gold. So gold minus 17%. Maybe it's the worst month since October 2008. What's going on there? Normally, you'd think that in times of real geopolitical unrest, normally gold should be going up again now. I mean, sure, gold has also had a strong rally recently, but that's a bit, well, I don't really get it.
Yeah, I do understand it actually, and I can kind of play devil's advocate here. I just think the gold price has gone up too much recently. In some places, the price has risen disproportionately high. And when the price is too high, at some point, nobody wants to buy it anymore. And then demand drops off a bit. And then the price takes a bit of a hit again. I think this 17% drop just brought things back to normal. You also have to keep in mind that the gold price has risen sharply over the last 2 or 3 years. So these 17% are nothing in comparison, except for those who maybe just invested in gold for the first time a few days ago. They've just had a bit of bad luck. But that's always the case when something's price rises sharply. And that happens over months and years. So you always have to expect that there will be a drop or a correction at some point. And that's exactly what's happening here. And yes, okay, you might think that things are really heating up in Iran, crisis is inevitable. But honestly, what's happening with Iran isn't all that dramatic. I mean, the coronavirus was much more restrictive. That affected people not being allowed to go out. Everyone was basically in lockdown. That was much more restrictive. The thing with the oil crisis now because of Iran, that's still something that allows for a bit of flexibility. The economy can still function, everyone can still move around freely. There are still opportunities to make profits in certain industries. That's a very different situation from what we had during the coronavirus period. And accordingly, I don't see it as if, due to the Iran situation, we are now in such a severe crisis. Right now, it's not such an intense crisis that we have to assume the gold price must continue to rise dramatically. Of course, everything could still change if Iran really escalates and it turns into a real world war. And if China, Russia, and the USA all get involved in that, if the Iran issue drags them in and they go into confrontation, then of course things could get really intense. But at the moment, you can see that China is largely staying out of the Iran issue, Russia as well. And that's actually a good situation for the world because it means there isn't a huge potential conflict between the major powers, but rather at the moment, it's still just a conflict here between the USA and Iran. And Israel also plays a role, but Israel and the USA are kind of allied. They're acting against Iran. And of course, the Strait is now a certain problem for the economy, but it's just an economic problem among many problems that the economy generally always faces. Then the economy isn't stupid either. The economy also has the ability to look for solutions in every crisis. So I think people are quite optimistic, and accordingly, it's completely fine that the gold price is now also pulling back a bit.
Yes, you definitely summarized that very well, very concisely, or rather, also from your perspective. Of course, everything explained clearly. What I would like to add briefly, yes,
We can talk again in a month. Maybe in a month, the gold price will have risen by 50% again. Then we can discuss whether I made good arguments or maybe just talk nonsense.
well, let me put it this way, that's true. What I would say is, well, the market usually does exactly what you don't expect, maybe. Especially with the gold price, you might have seen that as well. Of course, as you already said, we've had a very, very strong rally up to this point. And the fact that it pulls back a bit is just part of it, really. Yeah, but I'm curious to see what happens. But as you already said, even now it hasn't had a positive effect. And you're still right, yes, but I'm curious to see how all of this will develop, especially regarding oil, gas, and LNG, because some people in top management, like at Shell, are already warning that there simply might not be enough oil. But I'm really curious to see how all of this will actually develop. But according to these forecasts, things aren't looking too bright. Yeah, but in the end, we'll just have to wait and see. Otherwise, what you can also see is the volatility index. And right now, we really have an average of over 20 to 25, which simply means, well, the volatility index is just 50% higher than it was in February. That means it can just as easily move quickly in one direction or the other. And as the name suggests, it's simply more volatile in the end. And maybe it doesn't just drop by 0.5%, but sometimes even by 3%, or even upwards too. So that means right now it's just moving a bit faster in either direction.
Yeah, you could see that as negative news right now. In fact, news like this should actually signal to long-term investors, hey, this is a jackpot. Why? Because strong volatility means that the stock market can swing up and down more quickly. That means a long-term investor simply has the chance to get lucky and to suddenly invest their monthly savings rates during a dip. And at the same time, it can happen that after a few months or even just a few weeks, it rises sharply again. And that means you bought in at a low price. And then you're happy about the quick and also high profits you can make during that phase because you were lucky enough to invest your savings rates in the right dips. So volatility actually gives you a bit of an extra return booster. If things only move sideways or with low volatility, then it just rises steadily and you can't invest at a low price. That's not necessarily a bad thing either. It feels safer when the stock index doesn't fluctuate so much. But ultimately, high fluctuations are actually good for reinvesting, especially if you have monthly savings rates or maybe even make weekly deposits and then just wait long term. Then such periods of high volatility can be a bit of a chance for bargain purchases.
Yeah, so you're a classic example of turning something negative into something positive. No, but of course, you're absolutely right.
We always have this problem here. Oh God, the news. And I mean, I've been in the stock market for 10 years now, and every time it's the same situation. And every time I myself get scared when there's a drop in prices. And as you said, the S&P is just about down about 5 to 6%. Oh, market crash. No, it's simply just a correction. And you can just wait it out now. And you don't have to freak out right away and somehow think you need to reshuffle your portfolio now because that's exactly what happens. You bought in at a high price, probably in the last 1 or 2 months. Now you sell because there's been a drop in prices, and then you get back in when prices are already at new record highs. That's exactly what you're not supposed to do because that's how you lose the important moments when you actually make the highest returns. The classic sources you have as an investor, it's always this psychology that you act irrationally and not in the way that would make the most sense to get the highest returns. And you get the highest returns by doing nothing, simply by staying invested for the long term and just waiting out such phases, and then maybe just investing in something like that. With a bit more luck, you might get even higher returns.
Yes, you can just use a classic example and simply say, okay, if you're investing in an ETF, for instance, you just don't look at it at all and let your monthly savings plan run automatically. If I somehow notice that, to put it bluntly, things are really hitting the fan, then maybe I'll increase my savings plan or just manually add more to it, increase it somehow, or whatever works. There are a lot of things you can adjust there, and then you just don't look at it. And that's perfectly fine too. So you don't have to check because in the end, it's money you don't actually need anyway. I mean, I don't know. I check every day.
Me too, even several times a day. During the day, we must have already made a 100 euro profit again, or maybe even a loss.
Yeah, or whether you've received any messages, whether you'd rather have stocks for the dividend or prefer the payout. There are also a lot of things where you really should check in from time to time, or quarterly reports or whatever else. You also get everything through the broker, whatever you end up receiving. You have to stay up to date somehow too.
Exactly.
Yeah, that was definitely already a very, very good summary of the markets. What's also quite clear, of course, is, well, yes, if oil goes up, it's obviously clear that the entire energy sector rises along with it. Then right now we're at about 18% there. And, well, many other stocks are ultimately falling. You can see that as well. For example, I can see right now that my portfolio is performing a bit better compared to the S&P or DAX. Ultimately, I see that the S&P and DAX are going down while mine is actually moving up. That's just what stands out to me right now, but that's also because I'm primarily invested in oil or shipping. And yes, apart from that, as we already mentioned, there are also the defensive stocks. And here they have gained a total of $80 billion in market capitalization. And that's certainly quite remarkable. So you can see that there's just a bit of rotation happening here. Yeah, so I'm just curious myself. I don't know how you see it, but I think, as I said, that defensive stocks, in my opinion, are actually still kind of at the bottom a little bit. I haven't seen any defensive stock that has really risen sharply yet, except maybe British American tobacco, so tobacco stocks. But a lot of things are still just at the bottom. I don't quite understand that yet, but usually the market also needs a certain amount of time and a certain process to build something up here so that the price can be pushed up a bit more, maybe.
Yeah, I think everyone is, well, everyone. Every war situation like this is, first of all, uncertainty, and uncertainty always leads to stock prices remaining a bit subdued everywhere. But as we've always seen in history, that can change quite quickly. And this entry point, you'll never get it perfectly right. You can never time it exactly, but it almost always comes. So at some point, the breakout will come. You just have to watch how things develop with the Iran war. At some point, a sense of security sets in. Not security in the sense that it's resolved, but security in the sense that you know roughly how things are going to play out. A prime example of this is the Ukraine crisis or the Ukraine-Russia war. In the beginning, there was uncertainty because no one knew whether Russia would gain territory and if Ukraine would soon be completely taken over by Russia. And at some point, it became clear that the situation was simply becoming entrenched, with Russia making no further new gains. And even the territorial division has kind of settled into a certain pattern. And for years now, there haven't really been any further visible advances. Accordingly, there is still war. The war has never been resolved. We're now in the fourth year of this Ukraine issue, but the Ukraine topic is no longer an issue at all on the stock markets because you can see that there are no changes. And as a result, there are currently no uncertainties regarding the Ukraine war either. And the same thing will happen with the Iran war as well. Either it will be resolved quickly there, which is also in Trump's interest because Trump wants to make sure that his actions in Iran don't somehow lead to problems. He also has to refinance the national debt he has in the USA. So the last thing he needs is for inflation to somehow reach record levels. Raising it and keeping it high permanently is something he will definitely want to avoid. He also has the goal of generally lowering interest rates in his country, and therefore the assumption, or what one would expect, is that Trump will do everything he can to resolve the Iran issue as quickly as possible so that there is clarity in the stock market about what is going on. The situation in Iran is such that everything has already been priced into the stock market, and then the stock market just continues on. In the same way, regardless of the Iran war, it continues to develop independently, just as it currently does, regardless of the Iran war or the Ukraine war. I hope that was understandable so far.
Yes, you really have already contributed a lot to the topic of the market. Yes, you're right. As I said, I mean, Ukraine and Russia, it has just, you could say, almost frozen in place somehow. Sometimes there's a territorial gain here, then it somehow falls back again. So there really isn't, I would say, anything new or significant coming up that would, let's say, shake the market. And yes, I'm also curious to see how things will develop with Iran. It was already said yesterday, that is Friday, that maybe troops have already been moved. Yes, I also think this weekend now, I mean today, Saturday, March 28th. You never know, so much can happen these days within half an hour or an hour. Yes, let's just hope for the best, I would say. So what we can definitely already state now is exactly what we've already said. So money is flowing out of tech, and instead it's going into energy, defense and also into real assets. And that's exactly it. That's the rotation we've already talked about once or twice, I believe, here in this podcast or YouTube video, whichever it may be. Yes, and right now it's just the case that hard asset investors, I think, are already noticing that their portfolios are, let's say, picking up. I don't know. Are you actually invested in oil through an ETF or something? Or are you also putting something into hard assets more or less somewhere else? Or are you really more like focused on tech, S&P and DAX?
Yeah, I actually have a mix of everything. In my dividend portfolio, I also have ETFs. They're broadly diversified, but I also have some individual ETFs that focus a bit more on the so-called dividend gems. And that includes companies like BP and Shell as well. That means because of that, I also have a few that are quite broad, diversified ETFs that also have a bit more exposure to the energy sector.
Yeah, right. I mean, it's also important to always keep that in mind as well. Personally, I also always see it a bit as, let's say, a kind of risk hedge, just like either directly with gold, silver, or simply gold and silver miners, accordingly.
Yeah, and in my growth portfolio as well, I actually just recently uploaded a video about it myself, about a stock fund from Optinova, which also focuses on commodities, precious metals, and industrial metals, and also the various affiliated corporations and businesses that produce and refine these materials. That way, I also have a certain portion where I achieve this diversification into tangible hard assets and physical commodities. And you can clearly see that such stocks also have a certain stability during challenging and volatile periods within the financial markets, because they can gain advantages through entirely different mechanisms from those specific situations.
Yes, and especially in that sector, you always need, so to speak, demand. Otherwise, in the end, the industry will come to a halt. Yes, ultimately, the industry shuts down, if you want to put it that way.
Exactly. Yes, what you can see as well, it always goes like this. During a crisis, at first there is a state of shock. The stock market drops a bit briefly because it's simply unclear what the consequences will be. People prefer to initially price that in negatively on the stock market rather than quickly letting everything let stock prices rise, which might not be justified. And then the second phase is that people look at how corporate profits develop, basically after the start of such a crisis or after such a specific event in the global situation. And that's how it was with the war in Ukraine. That's how it was with the coronavirus crisis, and that's how it was with the crises before that. Then you see, okay, there are at least certain sectors that can handle these complicated market situations. Some of them might not be affected at all or could even benefit from them. As you already mentioned, as the energy sector is profiting from this. So it's not like we're seeing the end of the world here. On the contrary, there are simply beneficiaries who are making even more profits than before. In these wartime situations, it's also the defense industry that benefits greatly and tends to generate excess profits rather than losses. Then there are probably plenty of other sectors that are also making profits. For example, quality stocks, which have a certain solid business model, can continue to generate profits even in difficult market situations. What else did I want to say? Who else benefits? Or maybe you can think of something else.
Yes, well, I might also.
Oh, right. Yes, I wanted to mention technology. You mentioned that there's a market rotation out of technology over into safe havens. Now, with this whole Iran issue, it could also be that things reverse again, that people realize technology actually isn't really that dependent on, for example, oil and gas. It's the work of developers and programmers behind it. They can continue their work without any problems at all. They're much less restricted by that now. So maybe this is now another market phase where we see a counter rotation, where AI and technology could get hyped up again. That could definitely happen again.
It's certainly an interesting theory, especially considering that, for example, AI or software, yes, are now also being used very heavily in the military, for example, or also, for example, in drones. After all, that's essentially the same thing. So, yes, the theory is definitely justified, but you always have to look or pay attention, yes, to how much software is actually involved in something in general. And you also have to keep an eye on that, especially now, for example, with regard to servers and data centers, that of course they are also experiencing massive cost increases in light of this situation. Of course, you shouldn't overlook that either, but otherwise, I definitely agree with your point. Yes,
And you can also see how things are developing in the market, especially when it comes to finding solutions. Now we have a problem. Gas and oil are getting expensive. So now software might be able to benefit from that. Now you mentioned, okay, data centers, they could have problems again, but what if solutions are developed there as well so that we actually switch to renewable energies? And maybe now with an even bigger push, we could become independent from oil and gas. Then you're in a situation where maybe you can actually save yourself from the effects of higher electricity and gas prices. Or maybe instead of gas and oil, you could also build mini reactors. There are also some ideas that this might be efficient, that you could basically, well, uranium, when you convert it in a nuclear power plant to generate energy, you end up with what's it called, nuclear waste as a final product. And apparently, in these mini reactors, you can also further process this nuclear waste and generate additional energy from it. That means you can basically use the already existing nuclear waste to generate even more energy from it. And in doing so, you wouldn't be creating new nuclear waste, which is, once again, these are highly sophisticated and intelligent solutions, innovative ways to develop entirely new and effective approaches out of the current, increasingly difficult global energy situation we face today that can truly help us deal with it effectively and sustainably.
yeah, exactly. That's absolutely right. And in fact, you're actually talking about SMR,